Good morning, everybody. My name is Roger Edwards and I'm the Marketing Director of Protection Review. And on behalf of everyone on the team, I'd like to welcome you to ProtectX6. Now, whether you're watching this today, live on Thursday, the 21st of April 2022, or whether you're watching this later as a replay, I'd really like to thank you so much for tuning in. I'd also like to thank our event partners, DeadHappy. We're really pleased to have your support for this event. And DeadHappy came up with the theme for ProtectX6, and the theme is Protection 2030. What is protection going to look like way into the future? Now, as always, the format for ProtectX is the same. 7 speakers, each speaking for 7 minutes, followed by a live debate with myself and a couple of extra panel guests. Hot topics, controversial topics, topics that create debate. And we'd like you to take part in that debate. And as always, we're going to be using Twitter as our virtual chat room. So please do ask some questions, make some comments, and use the Twitter hashtag ProtectX2022. That's ProtectX2022. Please use that hashtag in every tweet that you make, every reply, every retweet. If you use the hashtag, people will be able to see it and they'll be able to reply and comment as well, and everybody will be able to get involved with the debate. In previous ProtectXs, we've actually trended on Twitter for the morning of the event, so we'd really like to try and get ourselves trending again this morning. Before we get started with ProtectX6, I'd just like to mention a couple of dates for your diary. ProtectX7 is going to be on the 8th of September. The main Protection Review Conference Dinner and Awards will be on the 1st of December 2022 at the Landmark Hotel in London. And of course, there will be a ProtectX8 as we move into Q1 2023. So let's kick off ProtectX6, and I'm delighted to welcome to the virtual stage from Tabei, Katie Crook-Davies.
We need to talk about flexibility and why I think it's key to future-proofing protection. Because can we really ask today's consumer to buy a protection plan that covers them for the next 25, 30 or 40 years? I think about my sister. She's in her mid-20s. She's a Gen Z. And I see her life as a squiggly line, the way she works, where she lives, and the types of relationships she holds. She strives for independence to follow her passions. She wants to be generating multiple streams of income. Yes, she has a 9-to-5 stable job in the banking sector, but that's not a career for life for her. That's an enabler for her side hustle as a personal trainer. She's bought and sold a property in her 20s and now lives back with my parents. And she sees herself starting a family, but much further down the line. And her story really contrasts to the experience of my parents. They've taken a much more traditional route. They bought their property together when they were younger and they've moved up the property ladder. They both have had careers for life and they had multiple children. But my sister really represents today's consumer. Someone whose career will change over time, who may move between rented accommodation and home ownership a number of times, and someone who may or may not start a family, and if they do, likely much further down the line. So can we honestly say that the protection solutions we provide today meet the changing and flexing needs of today's consumers? I think there's a bit of room for improvement, but perhaps I'm wrong, because my sister did in fact buy protection. On the advice of her mortgage broker, she took out life and critical illness cover when she first bought her home. But the good news ends there, sadly, because when she sold her property, she lapsed her protection. She saw it as some way linked to the mortgage, not a reflection of her life and her ongoing needs. Her cover couldn't flex as her needs flexed. And until she has another conversation with a mortgage broker, when she buys another property, if she does, she probably won't have another conversation about protection, which feels like a real shame and a missed opportunity to me. And let's hope that when she does do that, if she does, her health hasn't changed, because that's the other risk, isn't it? Good health is not a given, and the ease with which she took out her first policy should be taken for granted. And that brings me on to my experience with protection. Working in the industry, I knew I needed cover for my new mortgage when I bought my house with my partner in our early 20s. At the time, I decided not to buy income protection because I was employed and I had the financial support of an employer there. And I didn't really have the budget at the time for income protection. So I went for life and critical illness cover. And I had two options. One was a plan with GIOs, or guaranteed insurability options, and one was a plan without. Now, having bought a home that we loved, we couldn't really see ourselves moving anytime soon, and we certainly couldn't see ourselves expanding the family, for the foreseeable at least. So I went for the plan without GIOs. Now, fast forward 6 years on, I'm pregnant, we've just bought a new house with roughly double the size mortgage, and we're both self-employed. So we're facing a large debt that relies on two incomes, a baby on the way that we've been told brings a whole new host of expenses to your life, and we have no financial support from an employer. A pretty scary realization. It was time to revisit my protection. Understandably, my advisor said, let's check your policy, let's have a look at your GIOs and see where they can help. Problem was, I didn't take the GIOs. The other problem is that if I had have done, they probably wouldn't have allowed me to adjust my coverage to the extent that I would have needed for my new financial needs. So I needed to buy new cover. Now, the challenge was that since taking out my first cover, I'd not only got a few more years under my belt, a few more grey hairs on my head, I'd also been diagnosed with celiac disease, a condition that requires constant removal of gluten from my diet. Very sad news for the pizza and pasta I love so much, and a very sad realization that actually the complexity of the condition and some health changes would mean that I would struggle to get protection. So I was left in a situation where I could only get life cover, and really the valuable cover I needed as a self-employed person, income protection, that was sadly out of reach at that time. If only I'd had a crystal ball to know what financial hurdles and health hurdles were on the way, I would have certainly taken the plan with the GIOs, that's for sure, and I probably would have reprioritised my spending so that I could afford that really valuable income protection cover. I hope that my story and that of my sister provides some food for thought. So coming back to my first question, can we really ask today's consumer to buy a protection policy that covers them for 25, 30 or 40 years? Because a hell of a lot can change during that time, and so far protection policies haven't quite been able to keep up with all of those changes. So why aren't protection plans as flexible as perhaps we need them to be? Well, they were originally designed, if we're thinking about fixed term cover, to cover a fixed debt. So having a policy there in the way that it works currently, it makes loads of sense for people who are taking a traditional route to home ownership, just like my parents, and moving up the property ladder. For them, having a fixed term product for a number of years makes sense and would remain relevant for them. And having guaranteed pricing across 25 plus years is a good thing. It provides certainty to customers and helps from a budgeting perspective. And knowing that you have that cover there, regardless of health changes for a number of years, provides peace of mind. So how do we take some of the great features in the products that we have today and incorporate more flexibility so we can create a solution that better meets the needs of today's consumer? Well, GIOs certainly help, but we know that utilisation of GIOs is so low. Well, why is that? Are advisors talking about them? Do customers know what they are? Are they reading their policy literature to find out more about them? I think we all know the answer to that last question. And while we're seeing that GIOs are broadening in the market, which is fantastic, they're still quite restrictive. You can only use them a certain number of times. You can increase your cover by a certain amount for certain life events. And actually, if my sister had had the ability to adjust her policy when she sold her house, perhaps we would have avoided a lapsed policy and a lost customer. So how do we future-proof protection then? For me, it's all about giving customers the ability to adjust and flex their cover over time through different life stages. That could be increasing or decreasing their sum assured, changing their term of cover, moving from a fixed lump sum payout to an income payout. All easily. It needs to be done very, very simply. And this would probably require some change to the way that we price these products. It might be that we would have to move to annually reviewable pricing and premiums. And yes, that would likely incur some additional administration expenses and some complexity. But perhaps these things are worth it if we're seeing a better customer experience, improved persistency, and ultimately a better customer outcome. And of course, this whole idea isn't new. We see this flexibility in other lines of insurance, particularly general insurance, if we think about our car and home products. And the great thing is we're seeing a shift in the long-term insurance space too. As an example, Ladder Life in the US allow customers to ladder their benefit up and down depending on their needs. And the best bit is they can do it all with a few clicks of a button online. So for me, flexibility is the future. Let's adapt. Let's create products that flex as our customers' needs flex. And let's deliver protection solutions that can stay with our customers for life.
Thank you so much, Katie, for that really interesting take on flexibility. Up next, our next speaker is Tony Mood from St James's Place. So please welcome to the virtual stage, Tony Mood.
We need to talk about, do the current products and processes comply with Consumer Duty, and where do we most need to improve? Consumer Duty has been described by some as a paradigm shift in the FCA's expectations and as unnecessary FCA meddling in an area where there's existing regulation and guidance. My own view, without wishing to appear to sit on the fence, is that I have sympathy with both points of view. The FCA is trying to drive cultural and conduct changes in firms by placing an expectation that its approach will be embedded across the entire consumer journey. It's an initiative that signals an acceleration of the FCA's journey to outcomes-based regulation. It will impact different sectors of the financial services community in different ways, having a greater impact on those who are not as far along the journey as others, while for some will represent, in my view, little more than a reaffirmation of existing processes. Before looking specifically at the protection industry, I think we need to put a little more meat on the bones around Consumer Duty, which is really a package of measures rather than a single duty. The proposal is to introduce a consumer principle that requires firms to deliver good outcomes for consumers. Firms will be required to act in good faith towards their consumers without causing foreseeable harm, support consumers to pursue their financial objectives. There will also be a set of 4 outcomes relating to governance of products, price and value, consumer understanding, and consumer support outcomes. But I will return to these. Consumer Duty will apply to all retail consumers. It will also apply to unregulated activities, albeit only when they are ancillary to a firm's regulated activities, and firms that do not have a direct relationship with retail clients. For the protection industry, for me, this will include reinsurers, life companies, distributors, advised and non-advised, and a host of ancillary organisations connected to manufacturers and distributors, from those responsible for preparation of marketing materials through to anyone involved in the construction and delivery of advice. The FCA's own expectations are for a cultural shift in consumer focus. And while they do not propose to require firms to report on specific metrics, they do expect them to be able to demonstrate how they are meeting these expectations. Now, the fact that the FCA anticipates the implementation costs for firms to be significant, in many ways for me, is the most telling indication of the level of change they're expecting to see. Returning to the FCA's 4 outcomes, or at least 2 of the most relevant outcomes for the protection industry, the governance of products and services is the requirement to undertake product approval process, identify a target market, and ensure the appropriate distribution channels. Life companies have been doing this for quite some time, and if there was any doubt of the need for good product governance and having appropriate distribution channels, then Policy Statement 21.5, which is the General Insurance Pricing Practices, have made this abundantly clear. PS 21.5, as a precursor to Consumer Duty, should mean that the protection industry is well advanced in its preparation. The next outcome, price and value, is another strong theme within PS 21.5. And in my view, Consumer Duty adds absolutely nothing new. Do I think consumers receive fair value when purchasing protection products? Yes, I do. We have a strong, vibrant market in the UK with a broad and diverse range of products and some of the most competitive rates in the world. But I do have concerns. First, signposting, the value of which for me cannot be underestimated. Unfortunately, the FCA has made explicit reference to parties in the distribution chain should not receive remuneration disproportionate to cost. It could be argued that an individual making a referral will indeed receive remuneration which exceeds the cost incurred. However, this must be an unintended consequence. In practice, I believe there to be an exemption within the product sourcebook where the consumer would not otherwise receive advice. I do hope the FCA agree. Another is the first of 2 areas where I believe we need to improve, where there is no exemption, nor frankly is there any excuse for it, and that is the issue of loaded premiums. The problem with assessing fair value is that it is open to interpretation. It's subjective. The FCA have put the focus firmly on firms, but at the same time have said they are not proposing to limit margins. So does that give wriggle room to those firms that believe loaded premiums are acceptable? I don't think so, because manufacturers are required to assess fair value, and I fail to see how it can represent fair value at one price, distributing via XYZ, and also fair value at the price plus 20%, distributing via ABC. Manufacturers must be satisfied that their distribution arrangements are consistent with the product providing fair value. Going forward, senior managers in manufacturers making decisions to continue with loaded premiums, I think, need not only be confident that they are right, but that future senior managers will interpret consumer duty on this issue in the same way. If they don't, then they had better hope that they are no longer in a position that requires them to be within the senior manager certification regime. It's worth remembering too, the FCA have made specific mention that in their view, the more senior the individual, the greater individual responsibility he or she has. The second area I believe we need to improve is around the difference between advice and guidance. During the Consumer Duty consultation, a number of firms questioned whether non-advised sales were able to meet the requirements of Consumer Duty and whether the FCA should change the boundary as to when firms are judged to provide advice. The FCA actually declined, saying they were wary of reducing consumer protection which applies to advised sales. Now, I can't be alone in thinking they are missing the point here. Consumers often fail to appreciate the difference between advice and guidance. And we know some non-advised firms play on this confusion. Do the FCA really believe it's acceptable for these firms to give guidance to consumers, knowing that most believe they've been advised within a lighter regulatory regime? Now, I actually believe there is a place for genuine non-advised sales. We have an underinsured population, and without non-advised sales, we would have an even greater number of people without the protection products they need. What I object to are those firms playing the spaces, doing so knowingly because the regulations are sufficiently loose. So finally, can we improve? Yes, we do a lot right, but a midterm report card would definitely say could do better.
Thank you, Tony, so much for that talk. And remember, everyone, if you've got a question or a comment that you want to make, inspired by what you're hearing, please do talk to us on Twitter. And don't forget, use the hashtag ProtectX2022. Next up on the virtual stage, from DeadHappy, is Mr. Ed Edwards.
We need to talk about the future of protection. We all know that there's a protection gap. There are about 8.5 million adults who potentially should have life insurance that don't. That's 42% of people with unprotected mortgages, 50% of families that have no protection whatsoever. And we believe that the best way to close that protection gap and attract a new, younger audience is to redefine how people access and interact with protection products. At DeadHappy, we look at protection from a really different angle. Let's take life insurance. We've completely redesigned the process around customers' needs, not corporate profit, believe it or not. So what have we done? Firstly, we've made it more accessible. It's mobile first. You can apply on your smartphone. We use simple, plain English. There's no paperwork and definitely no sales calls. In fact, we don't even take their phone number, so we can't call them even if we wanted to. These things are already attracting a much younger audience who previously felt excluded. We've speeded things up. We've edited the question set down to just 4 simple health questions. That quickest application was approved in 1 minute 34 seconds, which is amazing. We've introduced flexibility. A typical customer's needs change around 5 times between the ages of 25 and 40, whether it's getting married, having children, buying houses, getting promotions at work, taking on other debts, getting fired, all sorts of reasons. We've made it easier to flex your protection in line with your life changes, not a bureaucratic, prolonged process or even cancelling to set up another policy later on. And we've made it cheaper. We base our prices on who you are now, not who you might be in 25 years' time. Our 10-year rolling plan can be reset every year. It's not front-loaded with fees in the early years for policies that are usually cancelled within 7 years. So from a product point of view and a practical point of view, we believe we're making things a hell of a lot better. But the real driver of change, the thing that excites us more than anything, and the reason why I'm talking to you today, is our death wishes. We don't ask customers, how much cover do you need? Because let's be honest, most of them don't really know. We ask, what do you want to happen when you die? And that's from the obvious big ticket financial needs of cover my funeral costs, cover the mortgage, pay down the mortgage, leave chunks of money for individual members of the family, maybe even uni fees for the kids, but also amazing experiences for friends and family. Pay for a round-the-world cruise for your sister's family, an all-expenses paid trip to Vegas for your mates, or really tiny gestures that make a difference in people's lives. Arrange for the bins to be taken out every week. Sounds ridiculous, but we've had people that have literally specified that in their death wishes. Send flowers to your partner to be delivered every week for the rest of their life, every day, every week, every month, whatever. We've co-created over 250,000 death wishes to date. Someone wanted their partner to adopt a dog. Actually, not just one dog, they wanted multiple dogs. Somebody wanted a cheese festival in their local village to be named after themselves, and to be held every year. And one guy who I remember, this is a lovely one, so it's quite close to my heart because I'm a father of 2 young boys. He wanted his son, his eldest son, to receive a brand new pair of football boots at the beginning of every season and to be remembered by his son for that lovely gesture. And there's some bonkers things you can do for yourself. It's not all about other people. Even though you'll be dead, you can still have the last laugh. You could blast your ashes into space. You could get a bronze statue made of yourself. You could even stitch up your mates from beyond the grave. We do get people doing that. It's fun. Why do so many people like engaging with death wishes? Well, because it makes the product benefits real, tangible, and personal in a way that no insurance certificate could ever achieve. Death wishes aren't morbid or scary. They're empowering and inspiring, whether they're financial or non-financial. They allow anyone to plan for their death, but with a sense of imagination. When talking about the future, we also have to talk about technology. At DeadHappy, our biggest investment is in technology, developing our platform and integrating that platform with others. And one powerful feature is the ability to share those death wishes with whoever you like, whenever you like. You could share funny death wishes with friends on Facebook or Twitter. You could share group death wishes on WhatsApp, and it could be the first one to die in the group ends up paying for the golf tour or the girls' trip to Ibiza. It sounds ridiculous. Actually, people are doing it. Plus, our Death Wish platform is separate from our products. So customers who have insurance with other companies or brokers will still be able to use our Death Wish platform and bolt it into theirs to help them plan the use of their funds and tell their beneficiaries. And our vision isn't limited to life insurance. We're currently integrating death wishes into wills too. So the starting point is always death wishes, and then the customer can decide whether to, 1, store them at deadhappy.com for free, 2, bind them into a will, which is pretty straightforward, or 3, if they haven't got the money or the estate to cover those weird and wonderful things they want to happen, then you can insure them via life insurance. So to summarize, what do we think the future of protection looks like? Well, it's customer-centric products built around their needs. It's increased personalization and flexibility. Ongoing customer relationships, not single transactions or contracts. And greater accessibility for all. At DeadHappy, our mission is to change attitudes to death. And we think death wishes can help us to do exactly that. Thanks for listening.
Thank you so much, Ed, for your contribution to ProtectX6. And I'm absolutely delighted to welcome our next speaker from Insuring Change, Ruth Gilbert.
We need to talk about who gets the death benefits from life cover. After all, without the person the money is meant for, the cover's not needed in the first place. And term assurances with just life cover are the most commonly sold protection products by far. Over $1 million a year, with average cover well over £150,000. People don't take this cover out randomly, thinking that'd be nice for someone. Of course not. It's for someone specific, who really needs the money if the customer dies. So who is that? It's safe to assume the majority are couples who've set up home together, and maybe with children. But what seems to have crept up on us is how many of these couples may not be married or in a civil partnership. ONS figures show that the proportion of couples cohabiting under the age of 65 has gone up in 20 years by nearly half, to over 1 in 4. For under 45s, the group we sell most life cover to, it's 1 in 3. But do the same proportions apply to buyers of life cover? Research into typical buyers by iptiQ and InsurTech Business included how many couples aren't married. And guess what they found? Yes, 1 in 3. And this really matters. Life cover is all about peace of mind, knowing that if you die, your family will be okay financially. At least your partner and dependents will get the death benefits, won't they? Or will they? Well, quite possibly not, unless you're married, and even then they might not get everything. But cohabitees have no automatic rights to inherit anything when their partner dies. If there's no will, intestacy rules pass their property to whoever the law regards as next of kin, which could be their parents or maybe children, but definitely not the cohabiting partner. What's worse is an awful lot of them don't know that, and certainly few people under 45 have made a will yet. Yet our product design, processes and communications seem to take little account, if any, of our cohabiting customers to make sure the life cover meant for their partners will reach them. They just don't seem to get a mention, even when options for how policies can be set up are explained. For a start, there's how we talk about the large subset of life policies that do have it baked into the contract to say who gets the money. I'm not talking about the Guardian or Royal London policies with contractual beneficiary nomination, I mean joint life. Websites and literature comparing joint life versus single own life make no mention of who gets the money. They say single policies give double the cover and are more future-proof, while joint life might be a bit cheaper. No mention of the fact that the single ones won't necessarily go to your other half. For single life policies, that's obviously a big problem, but you rarely see that mention in the risk factors listed in key facts. And for the large proportion of these sold without advice, whose responsibility is that? And single own life policies really are a big problem, increasingly being the most commonly sold. Swiss Re found that in 2020, they accounted for over 3 in 4 of 1.1 million level and decreasing term sales. The even bigger problem is how few of these get set up in trust. At the last count, a more than doubling of the proportion of these over recent years still only just took us into the teens. There's many reasons for this: complexity of the concept, wordings, processes, high error rates, unpaid hours advisors have to spend on them. Some advisors just avoid them in case of trouble from giving trust advice. Of course, there's even less chance in the advised channels, not least because the need to direct the money to the right person is so often underplayed, and rarely mentions cohabitees. It's still often suggested inheritance tax is the main reason you might want to consider a trust. In reality, well under 5% of deaths have triggered an IHT liability for years now, so we've been focusing on the wealthy few who risk losing up to 40% of the proceeds, instead of maybe 7 times as many people who risk losing 100% of the money. Not only that, but cohabitees don't get mentioned in the trust. If the current cohabitee has not already been named by the settlor, the trustees can't fix that after death, because current trusts don't have cohabitees as potential beneficiaries. So obviously this is a horrendous problem for any bereaved cohabitee who gets caught out with this. But how is it a problem for the industry? With so many people who may miss out on the cover meant for them, it's hard to see how this meets existing product and sales suitability and fair value rules. But it becomes even harder to ignore under the new consumer duty rules. Fair value is to be tested throughout the distribution chain, which means it should no longer be possible to play pass the parcel with responsibility for this. And the FCA has described unfair or poor value as meaning unsuitable features that can lead to foreseeable harm or frustrate the customer's use of the product. You can't get clearer than that. But do we want to wait for the FCA to spell it out even more specifically before we fix this? Will this still be a problem in 2030? I really hope not, because we can solve this. We've done it before with a problem with life cover payouts, which was the long time many claimants had to wait. 2010 was a turning point prompted by the FSA and the ABI. 10 years later, average payout times had plummeted in comparison, thanks to more pragmatic practices. In 2020, the problem for cohabitees started becoming clear, and now we have the ultimate nudge in the shape of the consumer duty to deliver fair outcomes. What's more, we now have 3 insurers, and more coming, who have embraced the fact that contractual beneficiary nomination built into life policies is the more pragmatic solution to safely directing the death benefits. So, for 2030, my unsurprising hope is that maybe 90% of single-own life policies will be written that way, with the rest in trust. Whether the industry will be willing to make that happen is down to you.
Thank you so much, Ruth. It was really good to hear your views. Our next speaker comes to us all the way from Australia. He is the CEO of startup Grapefruit Life. So please welcome to the virtual stage, Mr. John Clark.
Hi everybody. We need to talk about a fundamentally different approach to how we price life insurance. I was recently talking to a senior pricing actuary, and he said to me he had more chance in forecasting next week's lottery results than he did on getting pricing right for life insurance. And that kind of got me thinking, why is it so difficult? Now, in recent years, we've seen pretty much all life insurers increase pricing by as much as 50% for both level and step premiums, primarily across living benefits like TPD, trauma, and income protection. Now, long-term level premium is already a difficult customer proposition, given that most customers don't stick around longer than maybe 7 or 8 years. But imagine telling a customer that's on a level term product that their pricing is increasing because we got our assumptions wrong. It's a really difficult message, and it hits the trust of the consumer in the insurer. Imagine in the banking industry, a bank that issues a 5-year fixed rate mortgage, say 2 years later, goes to the customer and says, we need to increase your price because we got our assumptions wrong. It just doesn't happen in banking, and neither should it happen in life insurance. Now, the way that actuaries have price risk over the years hasn't changed much in probably the last 50 years. It's very reliant on mortality and morbidity tables, and therefore, by the very nature, is backward-looking in its approach. Yet we know there's a lot of different health trends out there which show that certain conditions have been increasing from year on year, like, for example, mental health. So how can we forecast for the future more accurately when we just look to the past and we don't look at actual trends? In terms of data analytics, we've seen most industries out there embracing it, from airlines to supermarkets to telecoms. But in the world of life insurance, we've only seen this used at a very peripheral level. And yet there is so many data points out there that can be used that help to predict risk for customers outside of just pure like health related and medical related. Yet for some reason, the life insurance industry hasn't embraced that, and it needs to going forward. When it comes to health and wellness, there's definitely been some great progress made over the last 5 to 10 years. For example, AIA Vitality and more recently Zurich Live Well, to name but two. Here, the engagement with customers is much more deeper than just a one communication a year to tell you how much the price has increased. It's all about rewarding customers for activity and keeping themselves fit. And it's a real step forward in how the industry has moved on here. But in terms of overall targeting, most health and wellness programs are targeting customers or trying to make customers fitter rather than targeting fit customers. And I think that's really a big ask for a life insurer relationship with the customer. Also, look, diet is pretty much not included within any of the assessment of risk and health. Yet we know there's a huge amount of data out there that shows that diet has an impact on your health. So, for example, a vegetarian diet, the research indicates that mortality rates improve by about 12%, and there's a reduction in cardiovascular and cancer risk by some 45% as a result of that diet. Yet we don't take that into consideration at all. But on the other side of things, we've still got many life insurers that accept a BMI level as much as 37. That's me with kind of an extra 30 kilos at standard lives, which really doesn't make sense at all. The movement to reward and support customers' health through various health and wellness programs, I think it makes absolute commercial sense. And in the future, we need to look at other aspects of data here, like, for example, sleep and resting heartbeat, which we can include within our risk assessment, in addition to overall diet that I mentioned. Now, when it comes to occupations, typically in life insurance, the occupation classes are all grouped into probably 5 or 6 different classes, or maybe up to 10. But it tends to be a grouping of over 1,000 or so occupations into things like heavy blue, light blue, professionals, white collar, that type of thing, which is all well and good. But when it comes to the overall assessment at claim time, we find that the assessment is based on those groupings. So if it's based on professionals, the outcome might be we had a worse experience in the professionals group than we did compared with expected. But often we don't know where that problem lies. Is it a lawyer? Is it a doctor? Because the data just isn't there at all. And so it's very, very difficult then to price accurately going forward when you haven't got an understanding of your overall data at claims point that you need to have in order to be accurate in your assumptions. And not only that, most life insurers actually, for term life, don't assess occupation at all. So I could be a 40-year-old truck driver or a 40-year-old fitness instructor, and I'd still be paying the same premiums. I'd still be treated the same, provided my health is the same or my health assessment is the same. So this is, let's face it, crazy when you think about it, but that's how most life insurers operate. Another major impact on profitability and pricing is the commission costs and associated costs associated with acquiring a customer. Now, most insurers use an accounting method here called deferred acquisition cost, or DAC for short, which amortizes these costs over the expected duration of the policy. In many ways, this is like a Ponzi scheme that makes Bernie Madoff's old business look like child's play. A kind of DAC cocaine, because once you're on it, you can't get off it. But the problem is, once the sales stop, everything unravels. So the next 10 years are important for the industry to make step changes in the way it prices for risk. This includes the use of data analytics, underwriting, and pricing for healthy lives. It isn't an incremental change, it's a fundamental step shift in the way that the actual profession operates. And by doing this, it makes pricing less of a lottery and guarantees the viable future for the industry. Thank you for listening.
John, thank you so much for your contribution to ProtectX6. And everyone, what did you think of John's views? Please let us know on Twitter, always using the hashtag, of course, ProtectX2022. Our next speaker is from Pacific Life Re, and his name is Phil Edbrooke. So please welcome Phil to the virtual stage.
We need to talk about whether insurers and reinsurers are ready for the pace of change. We consider pace, or at least fast pace. This is something that might not always be associated with our industry. It might be levelled at us that we're a bit of an oil tanker. And perhaps that perception is not wholly unreasonable. We do commit to covering people in their time of need. We commit to doing this over typically long periods of time for events that are relatively infrequent and for events that can occur quite a number of years after a policy, for example, is purchased. And so these long-term guarantees, combined with a really slow emergence of data, can make it really difficult to build feedback loops that help us understand whether we've got things right or wrong. And so when we consider pace, I consider this from two angles. We've got the rapid pace. Are we ready for the rapid pace associated with technological advancement? Are we ready for the rapid pace of change that we see in society? Perhaps those areas where the pandemic has been a catalyst. But on the flip side, are we ready and prepared to embrace the slower pace, the slower burn? Are we ready to embrace this and use the time productively? Modern life has become about immediacy, but should we be more disciplined and take a step back, allow ourselves to be truly long-term driven and coming up with sustainable ways of tackling emerging markets? Technological advancement is exponential. That much has always been the case. And it follows that if we look back at the last decade and see the change that's occurred there, the next decade, we could be in for quite a ride. And there's going to be technological advancements that we can't yet comprehend. Of those that we can fathom, a lot of these in our industry are going to boil back down to data. So data is able to help us optimize underwriting journeys. It's able to help us optimize product design. So able to help us optimize customer journey. You name it, data helps. And data really does underpin a lot of the things that we do. With computing power harnessed by data science, we're able to really sort of supercharge this data and find relationships that aren't visible to the human eye. But we do have several hurdles to overcome. It's important that we supplement the domain expertise that we have within insurers, reinsurers, distributors with that subject matter expertise. We know that in the data and tech world, jobs are quite transient. So what you get bringing data science involved is lots of up-to-date, best-in-class data science techniques. But you might be less likely to get some of the domain expertise that helps you contextualize results. On the flip side, if you take some of the mathematical folk in your organizations that have an interest and a good understanding of data science techniques, you're going to get a lot of the domain expertise. But you might run the risk of using people that have been reared in the confines of our existing world. And so the insurers and the reinsurers that do well will be those that find that right balance, that combination of complementing skill sets that allow us to become greater than the sum of our parts. Now, as I mentioned earlier, pace of change is often assumed to mean fast pace of change, and fast is assumed to mean good. But do we risk losing sight of the value of patience? Are we prepared to embrace the opportunities that the slower burn might afford us? If we take the aging population as an example, so this is no new concept, but the aging population, as this concept was emerging, was just that. They were aging. The market perhaps wasn't there yet for privatized offerings. It may well have been, but the example still holds. But should we invest more time in the future, start collecting the data, and make sure that any mistakes are made at a point at which they can be learnings rather than failings, and at a point where they're not large enough to put people off tackling such problems again in the future? Examples today could still be the care sector. They could be the gig economy and how our products are relevant for those. It could be the widespread utilization of wellness data. It could be open banking. But whatever it is, we can't afford to wait for the market to reach scale, because by then we've lost our head start. So even when the market is not yet substantial, should we be making better use of this period to build the foundations for the future? So what challenges are we going to face and what needs to change? We can create balanced workforces. So in dealing with rapid change, we need to make sure that we're humble enough to create workforces with balanced skill sets that combine the domain expertise that we have with the best-in-class subject matter expertise, for example, in areas like data science. And this collaborative approach will ensure that we're not held back by our existing thinking and we're able to be better than the sum of our parts. However, we need to ensure that the exotic doesn't outpace the ethical. In dealing with rapid change, we need to ensure that the sexy, exciting data science does not outpace ethical considerations. Data is objective. It has no moral, no societal or ethical overlay. As humans, that's what we're able to bring, and we must ensure that the direction that we take the market in is one that doesn't betray insurance's ultimate purpose in protecting those in need. Revolution, not evolution. So in dealing with rapid change, we need to ensure that the advances that in data analysis that we're tapping into, these are not focused just on improving the things that we currently do. They're not just focused on making these things better, but they're also turning their attention to things that we don't do. How can we use new data analysis, new proxies, to come up with ways of shortening feedback loops that will allow us to be more creative and brave with our product development? And on the slower side of things, we need to capitalize on the slow burn. So in dealing with gradual change, we need to invest in emerging markets while they're still emerging. With the passage of time, the problems only become larger, and we run the risk of missing the boat on collecting the data that will allow us to tackle these problems. And finally, we need to have the confidence to wear failure as a badge of courage. So in dealing with gradual change, we need to be less afraid of launching products that might fail, that might not sell. We need to be braver and more self-assured that if we pull these products from the market, we're not letting a customer down. It's actually making a valiant attempt to solve a customer need and is one step closer to getting it right. So if we bring it back to the original question, are insurers or reinsurers ready? A very difficult one to answer, and it's going to depend on the insurer or reinsurer. But if we change the question to be, are insurers and reinsurers well equipped to deal with rapid pace and to live with slower pace, then I think that's a yes. I think if we can show the humility to find the right people, to work with the right partners, then we really have the potential to tackle the next decade head on.
Thank you, Phil, for that really interesting talk. And now we come to the financial advisor's view, and we have a change to our advertised schedule. Unfortunately, Kerry couldn't make it today, so stepping in at the last minute is Robyn Allen from Robyn Allen Solutions. So please welcome to the virtual stage, Robyn Allen.
We need to talk about the future. We constantly talk about the past, we talk about tradition, we talk about the stigma in the industry, but we need to start looking forwards. At the end of the day, we all know, or we should all know, that protection is the foundation of everything that we do. And going forward, finances are changing for everybody, but especially the next generation coming through. And that's actually the reason I became an advisor in the first place. Back when I worked at the Halifax and I was having a career change, I basically had the choice. Did I want to become a mortgage advisor or a consultant that specialised in insurance? And I didn't want to deal with solicitors, so insurance was the route I went. But I very quickly realised how important the conversations were, how they didn't just have to be linked to life events, and that's the kind of thing we need to change. But when I left, I got told a lot. Why are you not becoming a wealth advisor? Why are you not doing your diploma? Well, first of all, because I don't want to. I've done enough studying. But second of all, there's a generation coming through who have debt. It's taking them longer and longer to get to where they want to go. I mean, when we're telling people that the average age to buy your first property is 34 and they could potentially be starting work at 18, that's nearly their life over again by the time they buy their property. And what if something goes wrong in that time? Well, that's what's pushing the age up. I mean, in 15 years, it's gone up, 6 years? What's it going to do in another 15? So that's why we need to make sure we're talking about these foundations, the building blocks, and make sure that their goals can be reached thanks to the safety net that we as advisors put in place. Everybody should have a talk about protection. Everybody should understand what they need, the consequences to them, whether they have insurance in place or don't have it in place. Because some people are willing to take the risk, and that's fine. It's not for everybody. Some people are happy to rely on family or use their savings or sell their rental property. That's cool. But I want them to be informed. I want them to understand exactly what is going to happen in that scenario should something go wrong. That is what we need to be doing and talking about. We need to make sure that people make fully informed financial decisions right from day dot. Now, we may say 18, that's the age at when they get their first proper bank account, they can have an overdraft, but we need to have these conversations even younger. We need to set the tone, set the precedents. Kids know, if you want to buy a house, you get a mortgage. Well, if they know that, why can't they also understand that if you have an income, you protect it? They know if you have a car, you insure it. They know if you have most people know if you have a house, you should insure it. And certainly most know that if you have a pet, you insure that. And your mobile phone. And you see where I'm going with this. We need to change the conversation. We need to change the language. We need to change how we approach it with everybody. It's why I'm such an advocate of social media. We can create something where we speak to them in their language because that's how they grew up. I had a phone growing up, but we didn't have internet. I was limited to 300 texts a month and they were normally gone in about, I'm going to say 2 days. It was really 1. But I was limited on what I could do. Now, the world is at their fingertips. So when it comes to how they go and get this advice, well, first of all, we need to make the conversation normal. I hate using the word, but we need to make it part of day-to-day life. We need to take away the stigma of saying things like the word death, because ultimately we are all going to die. Let's be real about it. Let's talk about it. Let's familiarise people with the language. And we also need to make sure that these conversations come at a time and in a way that suit that individual. 2 and a bit years ago when the pandemic started, I was all about the face-to-face. I'm going to hold my hands up and go, if you'd have told me to go online, I'd have told you to jog on. That's a nice way of putting it, isn't it? But now I'm converted. Zoom is my home. Other media platforms are available. But it's the one that people can easily relate to. It's where people feel comfortable. They are then in their own home. So I've pivoted, that famous word that came out during the C word time. But I had to. And it has meant that my demographic, they've got a bit younger. I mean, very recently, I've just completed a case for a 21-year-old buying their first home. Now, they were incredibly lucky in terms of deposit and where it came from. And they know that without that additional support, they wouldn't have got there. But they also understood, because of their parents, how important the protection was that they had put in place. And you know what? Hopefully they're moving in next week. Yay! But this is what we need to change. We need to make it more accessible. We need to make the advice simple, easy to understand. And I personally think that the future of protection is in advice. People don't have enough inherent knowledge to go and do it for themselves. It's not like your car insurance where you put in your reg, it brings up a value, it asks if it's modified. It's not like that with life. We need to talk to people about their lifestyle. We need to understand what they need to protect, what's important, what are they willing to sacrifice, what support they do have in place already, and what the reality of a situation is. I'm often called a reality check. And that is what we need to become as an industry. We need to modernise. The products have started to go that way. We are starting to see more and more out there where they're trying to make these things more user-friendly, but the processes behind them and the advice needs to catch up, and it needs to catch up soon, because 2030 isn't that far away. So for me, a lot needs to change, and we've got a short time to do it, but we need to remove the stigma. We need to make things simpler. And I love tradition, I respect tradition, but just because it's the way it's always been done doesn't mean it's always the best way moving forward. We can challenge it, we can change it, and we can make it better.
Well, Robyn, thank you so much for that really excellent speech to finish off ProtectX6. And of course, Robyn was the winner of the Protection Review Personality of the Year Award 2021. So it was an absolute pleasure to see Robyn here on the virtual stage. Now, before I introduce our panel guests and before we get into a debate about the issues and the topics that we listened to this morning, I'd like to say thank you to Robyn and all of the other speakers by doing what's become a bit of a tradition now on ProtectX, and that is what we call a Twitter thunderclap. So all of you that are watching, what I'd like you to do is type a quick sentence into Twitter. Now, it could be a thank you to the speakers. It could be highlighting the point that resonated with you the most over the last hour or so. Include the hashtag ProtectX2022. I'll just give you 30 seconds to type that sentence in to your Twitter account. And then I'll count down from 5 to 1. And then what I'd like everybody to do at the same moment is to press that send key, press that post key, and hopefully we will create a small tsunami of tweets on Twitter, which might actually push us up and get us trending a little bit higher. But mainly it's there to thank the speakers. So have you typed something in? Okay, here we go. 5, 4, 3, 2, 1, and hit that post button. Thank you so much. Thank you so much. So I'm delighted now to introduce you to our panel. And today we have Debbie Kennedy and Phil Zeidler. And what I'd like each of them to do to start off with is quickly introduce themselves and give us a little bit of background about what you do at your company, and maybe a quick fact about you that perhaps none of us actually know. So maybe I'll start with Debbie.
Oh, great. Thanks, Roger. Anyway, morning all. It was great to listen to all those talks as well. So I'm Debbie Kennedy. I am CEO at LifeSearch. We are a digital and advice-centric protection brokerage. I have been here now probably just coming up for about 6 months. So a lot of what I do at the moment is really getting to understand our business, but also forward looking. So very much the theme of the day. Been thinking about, where will advice be, not just in 8 years, but potentially 10, 20 years time. But more importantly, where will our customers be, and who will be those future customers? So delighted to try and talk about that today and get into a debate. Little known fact that there's probably lots, but what can I share? Maybe just if I wasn't doing this job, what would I love to do? And that would be to run a stationery business. How about that? A stationery shop, but only stocking the finest quality Japanese notebooks. There you go.
Fantastic. And Phil?
Hi, thank you, Roger. So my name is Phil Zeidler. I'm one of the co-founders of DeadHappy and proud sponsors of today's event. So DeadHappy, hopefully most of you will have come across. We're offering sort of slightly different digital solutions, mainly in protection, although we do have a rather broader purpose about changing attitudes to death, and really enjoyed lots of the talks today that referenced some of the things that we do need to do about thinking about people who have very different lives and different approaches. A fact that people don't know about me that's interesting is challenging. I guess maybe one which is very different. I've been involved in a few different businesses and a few different careers, as it were. And one of them was in the music industry, and I do have a gold album on my wall from the album we did with Madness back in 2007, the Liberty of Norton Folgate. So there we go. There's an unusual fact.
That's really interesting, Phil. I'll have to check that one out. So today we've heard a lot of really interesting stuff and calls from people for our products to be much more flexible, maybe to take a different approach to pricing. The word engagement constantly coming up. How do we engage people of all ages, but specifically maybe how do we talk to younger people, Generation Z, etc.? Now, if I'm honest, a lot of these topics have been around for quite a long time. You know, I'm sure that if we look back to a conference 10 years ago, maybe even 20 years ago, the topic of flexibility, the topic of engagement, and even the topic of pricing will probably have come up. And as Robyn said in the end of her speech, we're only 8 years away from 2030. And there's a lot of people asking us to do a lot of things. So if we haven't really pushed the bar very far in the last decade, the last 2 decades, how are we going to break out of this? Is it a rut that we're in? Is it a groove that we're in? I don't know. But how are we going to break out of it? And more importantly, maybe why are we stuck doing what we're doing? Maybe start with Debbie on that.
Thanks, Roger. Do you know, I agree with you as well. I think listening to those excellent talks, the thing that struck me as well were probably not many of them had new themes. And we have been looking at this, challenging ourselves, I think, as an industry for a number of years now. So where is the problem? Because I don't think it's financial services. I don't think that's the case, because, you know, look at the banks, look at the steps they've made in payments now, in how, you know, you can take a current account out, or the benefits you could get with that. Even just the way you can pay bills with your credit card, you know, in a restaurant with friends. General insurance, I think, has absolutely led the way with this, how they've approached risk with telematics and with micro insurance, and even investment. You know, now they're very much, you know, based on some gamification to bring to life investment. So where's protection? You know, why are we struggling? And I do wonder, you know, there were some hints to it through the talks, and I think from Phil and from John, you know, look at maybe how we approach risk, how we price, how we then design our products, and maybe importantly, how do we get these out to customers? You know, what channels do we use? And I do think there are some, you know, some really great innovations going on in protection, but in other markets. So if I look at the Australia Pacific market, Southeast Asia, and even, you know, the States, you can see some great products coming up, looking very different from the typical life term that we, you know, seem to major in here in the UK. And one of the things that strikes me when I look at that, though, they tend to have tied or direct sales forces. So maybe a question, which I'm happy to come back to, is, do our distribution channels need to help unlock this innovation? Is there a way that we can do this? And LifeSearch, you know, one of the things that, you know, I've always been attracted to LifeSearch for is that reputation to do something different. You know, Tom Bakery founded it on trying to find a different alternative to either IFA, face-to-face advice, or bank assurance. We have now developed much more hybrid customer journeys, either online, offline, guided assist, speak to someone with full advice. But I think there's even more we can do in that space. So I wonder if one of the themes is, you know, how do we get, you know, distributors to unlock some of this innovation as well?
That's really interesting. I think we will definitely come back to that topic as to how the advice sector can help with the product development process going forward. Phil, have you got anything to add to that, to what Debbie said on that particular topic of why we might be stuck in a rut or stuck in a groove with what we're doing?
Yeah, I think inevitably you have to think about what is the case for change. So if you're looking at our industry, and particularly how it's set up, in my view, I think very often what you have is the insurers see their customers as the distributors, the IFAs, rather than necessarily focusing through to the end customer point and spending more time about, what actually does the end customer really want and need. And, I think some of the challenges that have been put, particularly around flexibility of policies that Katie suggested and so forth, which are, completely normal expectations in every other class of product, they are big challenges for those insurers. And if there isn't a big agent for change, then I think we may well find that, not much will happen. I think what is likely to happen, and if you think about, as Debbie mentioned, big changes in banking and so forth and payment methods, the businesses that have come in are actually new businesses, businesses that didn't exist 10, 15 years ago, and they precipitated the change. And that it's easier for a new business to do that because the tech platforms and so forth. But if you actually think about, all these things, Apple Pay, how do most people pay stuff? You weren't even able to, they didn't exist 15 years ago. And I suspect there's probably going to need to be an element of that, because unfortunately changing, the status quo at the moment has proved very difficult in the past, and it's likely to continue to prove difficult for incumbents.
Yeah, and one of the things that intrigues me as well about the journey that we're on is, yes, these themes keep coming up, and people like yourselves, Phil, at DeadHappy, you're making moves in the right direction. For other companies, as you say, it's perhaps a legacy thing. For other companies, it's, well, our distributors want this, and there's no need for us to change it, despite what the customer might think. But what I really do think I agree with is this concept of, maybe now more than ever, the involvement of the distribution channels within the next generation of products is more important than it's ever been. Now, I'm sure, and I'm thinking back to when I was a product developer within a big corporate insurance company, we always said, yes, we involve the financial advisor in the development process. But maybe what we did is we developed a product, and then we did a little bit of research towards the end, and then we might have changed the color of the brochure or something like that. We didn't genuinely go and develop a product in conjunction with advisors. So maybe going back to what Debbie was saying before, how do we involve the distributor in the next generation of products, and indeed beyond the products, in the next generation of processes that surround the products, and the next generation of communications messages, engaging communications messages? What part are they going to play? And are they actually going to be enablers, or are they actually going to be a bit of a hindrance?
Do you want me to jump in there?
Yeah, Debbie,
Yeah,
go
I'll
ahead.
start and then Phil. I actually think we've got a really important role to play, and some of that's just borne out by my own experience. So having come from the insurer side, and like you, Roger, develop products, I remember once developing a product for diabetics, and then talking to a group of advisors and them telling me that it was far too easy for the customer now to get cover, and what was their role. And you can only imagine sort of my thinking there. And so one of the reasons why I've really wanted to move into distribution is I feel this is the sharp end. You are, the closest you're ever going to get to the customer, which I think was your point. So we have to make ourselves available, I think, partly, really upfront in that process of designing for customer needs, because we are talking to them day in, day out. And one of the things I'm doing at LifeSearch now is we really are starting to build relationships with the reinsurers. So to some extent, we're moving up that value chain. I know that every insurer focuses on distribution quality management. Every reinsurer is interested to get the data and the outputs to that. And we're having a very open book policy on that. You know, we're saying, look at what we do, look at our quality, look at the type of customers that we serve, and can you help us design propositions for those customers? And I think that collaboration, that very much not being arm's length anymore, will help unlock this sort of attitude to risk and really help, I think, embolden reinsurers and insurers in designing different propositions and taking, you know, really pushing underwriting to the boundaries, you know, of where you can go with it. So I'm very much for, you know, that distribution has to play a part now in this, has to unlock this value. But quality, I think absolutely quality is going to be at the forefront, because that's what will give, you know, I think the reassurance to the insurers and reassurers to actually be much bolder in what they're going to do.
And Phil, obviously, DeadHappy doesn't distribute its products through financial advisors, so you've taken a different approach initially and spoken directly to consumers. And one of the things that we heard today from Tony Mood was a lot about customer duty, the next level of regulation, and the fact that we are going to have to be talking to the customer a lot more and thinking about the customer a lot more. Have you got anything to add to what Debbie said there from the perspective you took when you developed the DeadHappy proposition?
Yeah, absolutely. I mean, we would completely agree with Tony. We think that customer engagement is fundamental. It just seems extraordinary that we all understand how people's needs change all the time, and that why wouldn't we engage with the customer on a regular basis in the same way that you do with every other product? And actually, the truth is, the good brokers do, and that's brilliant. It's a fundamental part of our model is to ensure that we contact customers every single year as a minimum, just to check that the cover they've got meets their needs, because it's sort of, that's what the FCA requires. It's the right thing for the customer. And I think coming back to that original question about designing products and customers, and I think absolutely the advisors have a really key role, because they're the ones who are on the front line. They're the eyes and ears of the insurers. And so they should be involved, but actually direct conversations with customers about what they would like to see is also, that's what we did when we set up. We went out and we did focus groups, and we did some qual and quant surveys. We spoke to them and found out, what would you like? What do you want to happen? And they're really quite articulate. It's amazing. The general public are not as stupid as you might imagine. They know what they would like, and they'll happily tell you if you ask them. And there just doesn't seem to be that sort of built in the design. Just one final point, it references the point there that in Phil's talk about our insurers and reinsurers ready for 2030. And our experience is, we have sat there saying, look, we have an engagement model. We're speaking to customers every year. What information do you need? What information would be helpful? And the truth is, actually, that's a question that really, no one we've spoken to really has an idea about. And if you think about the data points and the way that the underwriting that we do in protection and life, if you compare it to any other, telematics motor is probably the most extreme, where they're using data points on a daily basis of actual data on an individual level to impact risk and risk underwriting. That's where we ought to be getting to with life, but we're light years away.
One of the things I love about ProtectX is the interaction that we get on Twitter. So obviously, as we're talking here, everybody else is talking out there on Twitter. And John Ritchie has been particularly vocal today. Some fabulous tweets from John Ritchie, as always. But he's just really echoing something that you said there, Phil, is the question of are we actually in a growth rut at the moment? Do insurers and reinsurers really want to expand the market beyond the markets that we currently target through advisors and through the direct consumer businesses that are available at the moment? Have they reached the end of their desire to commit capital to it? And of course, he makes the point that distributors don't have access to as much capital perhaps as the insurers or the reinsurers do. So if anybody out there from a reinsurance company is watching this, it'd be really interesting if you could answer that particular tweet from John. Turning back now to the whole idea of flexibility, again, that comes up time and time again, but I thought Katie's talk today was so eloquently put, and just that little story about a sister and the differences between how their lives have developed really, really resonated. Everybody should really go back and watch that one again. And then we talk about, we heard from John from Australia talking about annually costed, and it does make me wonder whether we're starting to think about the end of long-term products. In fact, another tweet that we got earlier from Ben Heffer said that, if the future is a very flexible product, does it actually have to be annually costed? And does that sign the death knell for long-term products? Is the 25-year policy just something that will eventually fade away, especially when we look at mobile phone tariffs and annual premiums for car insurance and subscription models like Netflix and Amazon Prime and things like that tend to be based upon an annual package. But then on the other side of the coin, and Alan Knowles from Cura Financial Services also tweeted this as well, the risk at losing the longer term policy, of course, is how do we balance flexibility with insurability? And of course, if somebody's circumstances change, are they going to become uninsurable at a point in the future? So it is quite challenging, isn't it? How do we balance flexibility with insurability? Phil, do you want to take that one first?
Sure. Yeah, no, it's a brilliant question, and it's certainly not one we have all the answers to. We've got a position, but actually as an illustration that we're unclear, we're sort of developing a longer term product, one that's still flexible, that you can still change every year or how often you need to in terms of cover levels. And when we come back to it, if you think about it, the question, 25 years is just born up, probably linked out of the traditional mortgage product. That's sort of where I think most people accept that's sort of why that length. But it's a really strange number. If you think of people taking out cover at 25, 30, these policies are ending when arguably people are at their most vulnerable, 50, 55 years old. And so then the question is, well, when should you extend it? And that is the really interesting question. How much cover should you have ahead? And if you're completely risk averse, clearly you should have a whole of life policy. Yeah, that's very evident. We all know they're quite expensive. But if not, then how long is the right amount? And we've been doing quite a bit of research just trying to work out. It's where we ended up, as I say, with our 10-year rolling product, because in 10 years, the view is if you've been diagnosed with a serious illness, if it hasn't killed you in 10 years, it almost certainly won't. It will impact your ability to get insurance, but more like cost rather than whether you can or can't. But we don't suggest that that's right for everyone at all. Hence, we're looking at extending products. And I think a lot more research needs to go into all of this as to what is the right balance between flexibility. And ultimately, that will in part depend on people's different circumstances and their ability to, the old vulnerable customer check, their ability to deal with economic shocks and so forth and things like that. So I'm afraid we definitely don't have the answers. What we do think is that we should ensure that the customer has options.
And Debbie, have you got anything to add to what Phil said?
Yeah, I'm a big fan of Phil's products, what DeadHappy are trying to do, because I think the future is flexibility and adaptability. I think that came out as well. And as Phil said as well, it's something I call the suddenly unprotected. You can see now that people in their 50s are suddenly unprotected. Their mortgage cover has run out the term, right at the point that they do need it the most. They're probably now going to bypass protection and just think about their savings instead. So what can we do? I think we can do. I think what's holding us back is our approach to risk, to pricing, and actually customer engagement. There should be no reason why we can't have some ongoing, exchange of data with our customers that allows them to dial up and dial down their cover as needed and adapt it. And I think, when Phil was talking about DeadHappy now, looking at, that review point, I think that's absolutely the key. And I think that's where distribution brokers can play a part in that, being very smart about when you start speaking to the customers again. But why can't we have an ongoing exchange of data? I think we heard from John in Australia that, talked about different proxies for underwriting. And, we all, are gathering information on our wearables. It could be something that's just automatically shared that, you then say, actually, I do want to dial up my cover now, or I want to dial it down. And we've got some real-time data exchange. That maybe is where we need to look now for the future products. But also saying that I think some of this just isn't new as well. I do remember, designing a renewable, increasable, convertible term assurance probably about 20 odd years ago. And probably there's something, and I think it was maybe John Ritchie was saying, have we just got inertia, within our industry that, we pile them high term assurance, life only, our sort of back books throw off a lot of value for insurers and reinsurers. So, to make this next step and, redesign some of these processes and propositions as DeadHappy is going to do, it just might take, new thinking and new entrants to the market to do it.
And
sorry,
yes, of course, Phil, go ahead.
Can I just mention, there's one sort of elephant in the room that I think we have to, it's an issue we have to face into, which is about the economics of all of this. So as Debbie just described, it's not, what we've done with our rolling term, 10 years, so it rolls out, you always have 10 years ahead of you. You could do that with a 25-year product. It's been done before. And you might say, well, then if you can do that, you've always got 25 years ahead of you and it's refreshed whenever, after maybe 1, 2, 3 years. But there is an economic impact on distributors. And that is something that, people build their models around revenue streams. And so that is something that we are going to have to face into if we want an alignment of interest to ensure that the distributor is looking to build a model and a business that actually is aligned with the customer and protecting them over the long term. We're using some of these rather simple things because it does remove a significant earning opportunity for cancellations and rebrokings.
Yeah, it's a very good point, and it just adds to that challenge of balancing flexibility against insurability and also profitability, I guess. And as always in ProtectX, the 30-minute debate part of the show just flies by, doesn't it? There's so many things that we could talk about and dig into, but one of the ones that I wanted to focus on perhaps as our last topic today really comes about the whole engagement piece. Now, again, Robyn alluded to this in her talk. She's very prolific on TikTok, which a lot of people may not even have heard of TikTok, but it's a really interesting social media channel based around very short video content, and you can grow quite a big audience on platforms like that. There are other financial advisors out there who are doing similar things. Carla Edwards is another name that comes to mind. So engagement of the next generation of customers is so important. Now, I am very taken by the death wishes that DeadHappy do. I love that concept. It really gets people thinking about it. It's honest, and it's slightly fun as well. It's making fun out of something which a lot of people obviously think is quite a morbid subject. Also, Debbie, I know that one of the planks of LifeSearch's proposition has always been the inclusion of the added value services.
Yeah.
And I can remember, again, maybe it's going back about 20 years, maybe just casually thinking, will we ever get to the stage where the conversation about protection doesn't start with the financial bit? It actually starts with, well, actually, here's this practical helping hand, this red arc, this best doctors, whatever. That's what we talk about first, because that's actually the more engaging bit. And I can see that still when you have conversations about things like death wishes and the practical and emotional support from added value services. So again, I just wonder whether as we move more towards the future, are these a better way into the conversation than just saying you need to protect your finances? Or is that just too much of a leap? Phil, what do you think of that one?
Well, I guess, you might imagine we're a huge advocate of a Death Wish platform, and you've really articulated it very well as to why, in that, most people aren't ever going to buy. Insurance is a distress purchase, and no one's going to get excited about protecting a mortgage or an income. It's something you can feel good about having done, but it doesn't give you any joy, and there isn't that much of a personal attachment. And that really was, and I have to say, I can't take the credit. It was my co-founder, Andy, who came up with this concept. Again, as someone completely outside of the industry, says, well, look, what are the great things? What are the amazing things that you could actually think about? And how do you help people describe and imagine these benefits? Because the benefits is what people want to think about, and that's what the Death Wish platform is. And yes, there are obviously some odd and some strange ones. These are all being created by those customers out there who are actually the people that matter. So we certainly get a lot of love. We have 250,000 death wishes created, and one of the things we're actually now doing is we've split it from and we're saying to anyone who wants to use our Death Wish platform, they can. We don't actually care if they have a protection policy from a different place. If it helps them remind them why they've got protection, what it's for, and actually they can then share it. And this is and it'll also be to Ruth's point, that they'll be able to put them in trust, name a beneficiary and share that via WhatsApp or whoever with a beneficiary. That's all to our broader purpose of helping people think about, talk about, and plan for what is, after all, an inevitable event.
And Debbie, what do you think?
I really agree with that, but also lots of comments through the videos and Robyn's comment. We are a low engagement product, basically. That's one of our issues. I think we sometimes try to convince ourselves it's because it's complex. It's not, just low engagement. So anything that I think can mean that we are talking, in a way that resonates and is relevant to customers has got to be something that we focus on. I also think, you mentioned value-added products. I can already see that happening. We talk a lot about those at LifeSearch. And I think for me, it's just about, it brings to life what a customer's doing. It makes them think that they've done something quite tangible, because there's these daily living benefits that they can see. I just think anything we can do to show up where our customers are and talk to them in a relevant language has got to be powerful. That's the most impactful thing we can do.
Thanks, Debbie. And usually towards the end of these debates, I always ask the question, what's your one wish for the future of the protection market? But because we've been talking about the future of the protection market for the last half hour, I'm actually not going to ask that question. I'm actually going to finish with a quote from Ruth Gilbert. Now, this is from a tweet that Ruth put out after she did her talk earlier on. But it says, the future needs to be more flexibility, more future-proof, and more suitable. And I would probably add more engaging onto that as well. Phil, Debbie, thank you so much for taking the time to come onto this platform live today at ProtectX6 to talk about the future of protection. I think it's been a really interesting morning, a really interesting debate. So thank you so much for coming along. And everybody, please show your appreciation on the Twitter platform. Indeed, please do carry on the conversation during the day. Use the hashtag ProtectX2022. Let's keep the debate going. We can keep that hashtag trending throughout the rest of the day if we all continue to talk about these topics that have been raised today. Thank you so much to all of the speakers who created the videos for the show today. Thank you again to Robyn Allen for stepping in at the last minute. Next ProtectX7 will be in September, the 8th of September. So do please put that date in your diary. Final thing from me, thanks to DeadHappy and of course our long-term partners iPipeline for getting involved in the protection review events. Thank you so much for your support. Everyone, thank you so much for watching. Have a great day ahead and we'll see you for ProtectX7 in September. Goodbye now.